Hello, everyone. Welcome to video 8 of chapter 9. We've been talking about some non-arm's length transactions, rollovers to family members. I wanted to have this video to talk about income attribution rules. Let's move it to this screen. So, income attribution comes from taking income from the person receiving the money and applying it to the individual who really paid for that income vehicle. So, income splitting is the most effective way of saving taxes by taking income that would be held in the hands of someone in a high tax bracket and moving it to a family member in a low tax bracket. Now we have an individual who's paying less taxes. And because the family unit as a whole benefits from all of the income everyone makes, the family as a whole benefits. So the income's still in the family, but now we're not paying as much taxes. So it's a very effective way. But there's a few legitimate and acceptable ways to split income. We talked about pension splitting earlier in the chapter. There's also making contributions to RSPs and TFSAs for spouses. So it gets subtracted from my income, and then my spouse will add it to their income when they withdraw it. And then there's also that income splitting for the registered education savings plans, where I contribute from my after-tax income, but any of the investment income earned while it's in the account will get taxed in the lower tax bracket when my child takes it out for school. So attribution rules serve to limit splitting to acceptable forms. So what if someone's trying to set up an income arrangement so that certain income is going to someone else in a lower tax bracket? They're trying to split their income, but they're doing it in a way that's not acceptable. So attribution rules generally apply to investment type property. So I have shares in a company. Let's say it's a public company. That company might pay interest and dividends to their shareholders. So I have income by virtue of owning the shares. Now, let's say my income's very high. I'm making $200,000. I'm in a very high tax bracket. So any dividend I receive is going to be taxed at a very extreme rate. And so I think, you know what? What if I just take these shares I own and give them to my child? And the child will earn the interest and dividends. Now the income's going to be taxed at their rate, their hands. So we will still benefit, the family will still benefit from getting that income, but we're moving who's receiving it to the child. This arrangement isn't quite allowed. The attribution rules apply to say, okay, the child owns the shares, the child's receiving the income, but because the shares were really purchased by me, their parent, any income they earn is going to be included in my name, my income tax return. Because I generally, even though it's in their name, I, as their parent, still control the asset. I still made the decision to hold it in their name. So attribution rules are kind of taking the income that would be in a lower bracket and applying it back to the individual who functionally paid for that property income to occur. Tax on split income is similar to attribution rules. Well, it's similar as in it's a tax penalty or some sort of way to disincentivize these tax splitting arrangements. So tax on split income, called TOSI, applies to dividends if I owned the company. Having shares of a public company, okay, though that income amount's going to be applied to me, but I own a family corporation, and so everyone in the family owns shares. The corporation's going to pay out dividends. Now my children are going to receive dividends. If that income's determined to be TOSI income, a tax on split income, then they're not going to benefit from those low tax brackets. Their income's going to jump straight to the highest federal bracket, 33%, and likely the highest bracket in the provincial rates as well. So me trying to save taxes by putting the income in my child's name just makes it jump to the highest tax bracket, so there cannot be tax savings. So tax on split income comes in when I have control over the business to decide when and to whom dividends get paid. Attribution rule applies when it's sort of more of a public entity where I'm receiving the income, but I don't necessarily have the decision-making power on what the income's going to be. We will talk about TOSI rules. It's a lower priority subject. I think I'm going to talk about it at either the end of this video or maybe I'll follow up with a short video to follow this one. So what are basic attribution rule, or when do the basic let me start that sentence. When do the basic attribution rules apply? They apply if I transfer an income earning asset to someone in my immediate family, a spouse or common law partner, or generally a family member who's still under the age of 18. Now, the general non-arm's length rules immediately looks at siblings, parents, children. Income attribution will look at nieces or nephews of transfer. They're looking at young family members of the transfer. So nieces or nephews or children all follow into this under the age of 18 wheelhouse. It applies to the property income that the ownership confers. Shares get dividends, bonds and mortgages get interest. So if I take this property and transfer to them, the income that's earned from it applies the income attribution. If they in turn have capital gains, that might also be attributed to my income as well, if transferred to spouse or minor child. Income attribution doesn't come into play after my death. So if I'm still alive and I transfer the asset, I'm likely transferring it to them to receive the preferable tax treatment. But if I die, I'm not transferring those assets for tax savings. I'm transferring those assets because I'm no longer alive to own them. So attribution rules don't come into play if the transfer's passed away. It also doesn't come into play for business income. If I have a business and then I transfer those shares to my child who steps in and starts running the business, it's considered that the child's earning that income. So income attribution has to do for passive income, income where the child's not earning it themselves or the child didn't pay for it themselves. I owned the shares, I paid for the shares, I've simply put it in their name. So that's not business income. It's passive. You can't earn it. So business income does not apply income attribution, and income subject to the TOSI rules overrides income attribution. Instead of putting it back on my income, it's just going to get taxed at the highest rate. So income attribution, tax on split income, no attribution. Business income, no attribution. It's the property income and the capital gains that we're concerned with. So property income from spouse, common law partner, or related minor. Capital gains from spouse or common law partner. But the capital gains don't usually apply for attribution for the related minor. And it's because when I transfer an asset to a spouse, I can use those cost-based rollovers. So by transferring it to a spouse at cost, the capital gain associated with it should have been in my name. And so that attribution can come back. When I transfer it to someone who's not a spouse, it's considered to be transferred at fair market value. So because it's recognized at fair market value, I've already paid, like recognized capital gains. I've already paid for the change in value. So any further value changes can be taxed in the hands of the minor. So for both situations, the property income is usually attributed. For capital gains, it's mostly attributed from a spouse. So I guess we'll do the next couple. So avoiding income attribution. If I want to avoid attribution, the biggest thing I can do is exchange shares at fair market value. If I'm exchanging it at fair market value, in my taxes, I'm recognizing the value change up to the date of transfer. So any further changes in value are going to be in the hands of the person who received it. So making sure I transfer at fair market value. For related minors, if I don't want to attribute the income, the minor needs to have paid for it. If I bought the shares, that income is coming in because I paid for it. So the income's mine. If we can figure out how to get the child to pay for those shares, then the income will stay in their name because it's their investment. But they might not have the money. So what we can do is I can say, here's the shares for now of $100,000, and you're going to owe me the money. It's a loan. There's a promissory note in place. The government says, well, until they've given you the money, it's still in your hands. It's still from you. So the income's yours. But we can get on side by taking that loan and charging the child a prescribed interest rate that they pay. So if I'm saying, okay, it's $100,000 and the prescribed rate is 3%, that's $3,000. So the child might not have $100,000, but if the child can pay me $3,000, I can declare it as interest income, and now the child can recognize all of the dividends and interest from those shares in their name. So they have the income, they can likely deduct the interest they paid to me, that $3,000. So some income still being included in my return, right? I'm gaining $3,000. So if I'm moving $5,000 of investment income to their name, I'm still recognizing a portion of it, the $3,000 interest, but the rest of it will be at their tax bracket. A spouse, I must elect out of the rollover in order to get it to transfer at fair market value. So transferring shares or transferring assets at fair market value save you from attributing capital gains. Having the person pay for it, either by purchasing the amount or paying on a loan bearing interest, then they can save from the property income. So there's these two ways to go about it. Income Tax Act 56, this rule for non-arm's length loans, if the individual receives loans from a non-arm's length individual and uses loan to purchase property that generates income, or individual purchases property from non-arm's length individual that generates income, and as a result is indebted to the individual. Unless one of the main reasons is to reduce or avoid tax, income splitting, if the loan given includes interest at prescribed rate and interest paid. So what this is saying is it is regular. So this loan that we've mentioned, that I can give them a promissory note, but it has to be bearing interest. If my child goes and gets the loan from the bank, maybe my child is turning 18 this year, if they're able to get a loan from the bank and use that money to buy my shares, then they're not going to have income attribution. They've paid for it. They got a loan from a third party, a non-arm's length individual, and they used that money to purchase the property. Loans given interest at a prescribed rate, unless the main reason is to reduce or avoid income tax splitting. So even in this situation, they might still look, oh, you're still trying to appropriate income tax. This comes into play if I want to buy or sell shares to someone and I use my child as an intermediary, then that income attribution will still come back to me. But so instead of me selling it to the third party, that third party says, oh, I'm going to loan your child the money. They'll buy it from you. They'll sell it to him. And then we'll use the exchange of money to undo the loans. Well, that loan wasn't really in existence. The loan wasn't to facilitate purchasing of the property. That loan was sort of a pretense. It wasn't actually a loan. That child was holding on to the currency exchange while me and this third party individual completed the transaction. So they will look at those transactions to make sure that I wasn't just using the child to reduce or avoid tax, that we're trying to legitimately put an investment in the child's name. Okay, that is certainly enough of me talking about it. For the exercises, I'm leaving exercise 914 and 915 at the same time because both questions use the same numbers for cost base and fair market value. Um, it just changes who we're giving it to. Income attribution from a spouse, income attribution from a related minor. So let's get some details. On December 31st, Mrs. Nora Moreau gifts shares with a cost base of $23,000 and a fair market value of $37,000 to her spouse, Nick. February 2024, so just short of 2 months later, the shares pay eligible dividends to Mr. Monroe of $2,500. Shares go through a gross up amount, so taxable, this is $3,450. On August 31st, Mr. Moreau sells the shares for $42,000. Assume that we did not elect to avoid the rollover, so we transferred them at cost. What are the income tax consequences in 2023 and 2024 for both individuals? The first case is we did not elect out of the rollover, which means those assets exchanged at cost. So Mrs. Moreau's cost base was 23,000. The rollover ACB will be 23,000. So Mrs. Moreau, the deemed disposition at the cost is equal to the cost base. That's a long-winded way of saying there's no gain here. Our deemed proceeds match our cost. So in 2020, in the example is 2023. So in 2023 and 2024, in 2023, there's no tax consequence. That's the point of the rollover. The point of transferring things in a rollover is to delay a tax consequence. So Mrs. Monroe has no tax consequence. Nick receives the shares at that cost base of 23,000. So when he sells the shares in August for 42,000, he has a large capital gain. Now, this capital gain is part of the value change, was up to 37,000 when the shares were exchanged, and then an additional $5,000 after the shares were exchanged. So the total capital gain is 19,000, but Nick didn't pay for these shares. He got them by virtue of the rollover. So the capital gain will be attributed back to Mrs. Moreau's income tax return. At a 50% inclusion, we're going to add $9,500 to her return. And also, we collected $2,500 plus that 38% gross up. So the taxable dividend of $3,450 received in Nick's hands is also going to be reported in Mrs. Moreau's income tax. Using these same numbers, how is that different for the child? So the tax for the child gives us the same numbers. What are the tax consequences for Mrs. Moreau and for the child, Nikki, in the 2 years? You don't get rollover options for a child. There's no general rollover rules. So the transfer is going to be deemed to have occurred at fair market value. So in 2023, that fair market value was $37,000. So cost base was 23, fair market value 37. So Mrs. Moreau in 2023 has to recognize that capital gain of $14,000. So she's going to report the taxable capital gain of 7. Now here's the thing, because we transferred at fair market value, that capital gain's been recognized. So Nikki is going to hold the shares at 37,000, the deemed sale price. And when she sells it for $42,000, she's going to recognize the capital gain of 5,000. That additional value change is going to be in her hands because we transferred at fair market value. When we transferred at cost, all of the value was attributed back to Mrs. Moreau. When we transfer at fair market value, the additional value change is in the hands of Nikki because Mrs. Moreau already recognized her change up to $14,000. She recognized the capital gains in her hand. Only the future capital gains will go through Nikki's hands. But they were given to Nikki for free. Nikki did not pay for these shares. So the income attribution, the 3450 of dividends, is still going to go back to Mrs. Moreau. So there's two income types we're always dealing with: the property income, the passive income, and the potential capital gains. The third case is income attribution, use of loans. On December 31st, Nadim Bronsky sells corporate bonds to his spouse in exchange for a 121,000 promissory note. So the spouse didn't pay for them, but there's a loan saying she's going to pay for them. The corporate bonds have a cost base of 115,000, fair market value of 121,000, and the promissory note from his spouse is interest-free and has no specific maturity date. So we've called it a loan, but the spouse might never pay it. There's no set payment time and there's no interest bearing. So there's no consequence to the spouse if they just never pay this loan. Mr. Bronsky does not report a disposition at fair market value. In 2024, the bonds pay interest of $6,100 to Mrs. Bronsky, and on October, immediately after an interest payment, Mrs. Bronsky sells the bonds for $121,000. She uses the 121,000. 129 was what they were sold for. The 121,000 were used to pay off the promissory note owing to her spouse. What are the income tax consequences? The key here is until the payment was made, Mrs. Bronsky has not paid for the shares. So, and the loan has no interest. So she has not done anything towards putting money into providing for these shares. So the income attribution is going to apply on the passive income. It says Mr. Bronsky does not report a disposition at fair market value in 2023. They transferred the shares in 2023, or the bonds. They transferred the bonds in 2023, which means that they transferred it at cost. They used the rollover rules. So what does that mean for our result? 2024. The year doesn't matter. It's kind of the same way. It's just so Mr. Bronsky transferred them at cost. No disposition was reported. So the cost base was 115. The rollover ACB must be 115. So no gain in 2023. Since Mr. Bronsky did not report a capital gain, the spouse, when they sold it in 2024, showed capital gains of $14,000. Those capital gains are going to move back to Mr. Bronsky's return. The $6,100 of interest that was collected is also going to be attributed because the spouse has yet to pay for them. If the spouse, let's say it wasn't sold and the spouse paid after collecting the interest. So Mrs. Bronsky collected the $6,100 and afterwards paid the promissory note. The $6,100 will still be attributed because it occurred before any payment was made, but any interest payments after the payment date will likely not be attributed and stay in the spouse's hands. So I have tried to put this handy little guide here of how we attribute capital gain and attribute the income. Did we transfer at fair market value? If the answer to that is no, then we're going to be attributing capital gain. Did we pay for the property? Or if not yet paid, is the loan charging interest at a prescribed rate? If the answer is no, neither of those are happening, then we are going to attribute the income. So if I transfer at cost, but my spouse did pay for it at cost, we might still attribute the capital gain, but we wouldn't attribute the income. So we have these two income types we have to consider. So those are attribution of income. We're at 24 minutes now, so I'm going to just go the last couple slides talking about tax planning and income attribution, but I'll have a short video to follow up on the TOSI rules. So we want to split our income. The best ways to do it is through pension income splitting, TFSA tax savings going forward, RESPs and spousal RRSPs so that income contributed can be collected in their hands. Transfer capital property that we expect are going to have future capital gains to our minors. So when we transfer to minors, the income is going to be attributed, but the capital gains are not. So if we think this property is going to really get some gains in the future, transfer it now at fair market value, and those future gains will be reported in the minor's hands. If we're going to have a loan, charge the prescribed rates to save on that income attribution, and segregate gifts to spouses and minors. Clarify what is going as a gift to a spouse, what's going as a gift to a minor, so we are aware what income attributions might be coming back to us and how to avoid it. Always have detailed records to trace funds because it's very important that the income gets attributed to whoever paid for the return for the property. So if you have a family and it's supported on one income, one parent is working, then conceptually anything the family buys is being purchased by that family. So even if the spouse buys some investments and the children buy some investments, if they have no income source, then it's assumed that the income earning individual paid for those things. So if we want to establish, no, my spouse has their own job, their own income, their own bank account, these shares were purchased from the bank account. Here's the bank transfer, here's the proof. Then the CRA will accept and say, okay, no income attribution. I have proof of who bought the shares, of who bought the property. You can incorporate the business. Careful consideration will be given to TOSI rules, which I'll go into in the next video. And businesses can pay reasonable salaries to family members. So if I have a family business, if I have a family restaurant, my one child can be a server and a host. The other child can work in the kitchen, assuming they're old enough to be safely in the kitchen. My spouse can handle the office and scheduling work. I can run the restaurant and the bar during operating hours, and maybe I do a bunch of the hiring and stuff. So every person in the family might have different jobs. The business can pay salaries to every family member that's reasonable for their job. The hostess position that my daughter might be working, I can pay her a salary equivalent to what I would pay anyone working the hostess position. Let's say $40,000. If I'm paying her $200,000 to work the hostess position, the CRA might say that's an unreasonable salary for that particular job because there's no hostess at any other restaurants who earn that income. So we will limit the income reported on her return to $40,000 and the rest of it will be reported to you. So we can still recognize salaries. We just need to make sure we're being reasonable in the amounts. Okay. Thank you for your time. When we come back, I'm going to have one more short video. TOSI rules are lower priority in this chapter, at least for this course. So I'm probably going to run through that last video pretty quickly. Thank you for your time. See you in the next video.